All right, deep dive into policy loans. This is the last video of the series. In this video, we are going to look at a guardian policy that has a similar funding scenario to the last video. The difference is we're going to look at a 55-year-old female, and we're going to focus on their 10-pay product. Now, their 10-pay policy does have different limitations and different rules than all other guardian whole life insurance policies. Focusing on the loans, what we have with their 10-pay policy is as follows. When we first start the policy, we have a fixed loan interest rate at 5%. So that's just like everything else. At the 10th policy year, we can elect to change the fixed rate to a variable loan rate, which has a floor and current rate of 4%. That's the same as all other guardian products. Here's the difference though. If we elect to keep the fixed loan interest rate, with all other products, like their L95 that we looked at in the last two videos, at year 20 or age 65, whichever comes last, the fixed loan interest rate drops from 5% down to 3%. With the 10-pay product, here's the difference. At the 10th year, instead of the 20th year, so it's the later of year 10 or age 65, whichever comes last. Notice we're looking at a 55-year-old individual, so year 10's at the same point in time. But at that point in time, the loan interest rate drops to a fixed loan interest rate of 3%. So we can lock in that fixed rate at an earlier point in time. So we are going to look at a policy loan coming out in year 11 of $300,000 in this example. Same funding, $100K per year for 5 years. I want to touch on something important here though when it comes to the 10-pay product. Most guardian policies, when we design them for maximum cash value, will allow a maximum of 10x the base premium each year to be paid into PUAs. Their 10-pay has different limitations. Specifically, how it works is wherever we set that premium, if it's $10,000, for example, referring to the base premium specifically, when we dump money into PUAs, they will allow a maximum of 5x the base premium to be paid into PUAs each year, which would permit you, if this is your policy, to pay another $50,000 each year into PUAs. So I cannot go as aggressive, 10xing the base premium each year when illustrating policies for maximum cash value. They may allow that, but they may allow you to go higher, but at the same time, they reserve the right to cap one out at 5x the base premium in annual PUA payments. They don't allow you to illustrate any higher than that, with the exception of the first year, we can go 50x the base premium. But beginning year 2, the maximum is 5x the base. There's one other thing though, that's good to be aware of, which sounds great at first, but then when you look at the numbers, it's like, okay, it's cool, but it's not as great as I would think from a performance standpoint, is beginning the 11th year. It's a 10-pay policy. No premiums are due. However, they will still accept PUA payments. If you still have a 1-year term rider attached, you can continue to fund 5x the base premium in PUA payments. If the 1-year term rider has expired, we remove it, or we never had it in the first place, the maximum PUA payment we can often pay is up to the MEC limit or whatever the base premium was, so not that much. With all that said, that's good additional information. It's pretty cool to see that modeled sometimes. But at the end of the day, it's a good product to be aware of. However, a lot of people like the L95 or other products where I can 10x the base premium in additional PUA payments. Lets me commit to a lower premium and just shovel money into PUAs. Let's look at some loans, shall we? So first thing is first, let's take a look at the 100K per year going in. Now, you'll see that relationship line up here with the 5x limitation. So the underlying base premium here is what? $16,000 and change. Where did we come up with that number? Well, there's our base premium. Multiply that by 5. That's your PUA payment. Then add the two together. There's your total payment of $100,000 per year. So we've got a 1-year term rider attached. There's the cost for that term. This is a 55-year-old female. So still very low term cost when you look at that. As we scroll down here, this is the loan illustration we've got. Let's actually take a look at the growth illustration first. All right, here we go. So where is the money going? Breakdown of premium, total payment. Now, granted that this premium is higher, $16,000 and change, you get about 35% of that shows up in cash value right off the bat. So unlike a traditional policy where we have zero of the premium show up in cash value in the first year, in this guy, we do get about 30% right off the bat, 30 to 35. Premium's higher, but we see some of it come back to cash value. If you recall in the last video, we had about 83% right off the bat, 83,000 with the same 100K payment, where here we've got 82.5. So you don't see too much of a difference initially. You will see a little bit less. You see we don't have a clean break even of year 5. It's technically year 6 when I'm positive here. And she's paid into it a total of 500 grand, $100,000 per year for 5 years. Then just lets it sit and grow. Cuts the term rider after year 7, also executes reduced paid up. That's why I see the death benefit drop and the cash value continues to grow. Going to the loan scenario, here's where it gets cool. There's your $300,000 loan coming out. There's your loan balance. 3% would be what? Not 87.38. Do you remember what happens with Guardian? Before I just give you the rate. You have a discounted rate, 2.91%. That occurs if you're paying the loan interest out of pocket. So going back to this guy, there we go. What do we see here? Loan interest comes due and we pay it each year. Now, if we would have taken a loan up here prior to year 10, we would have seen that 5% loan interest rate. We did not take it until year 11. Why we did this is we've got a 10-pay product. We're locking in that lower fixed interest rate much earlier. Now, again, it depends on our age and when we're starting a policy. This person's 55. If we're 55 or older, we could implement something like this. If we're 40, we would have to wait until when? The later of 10 years or age 65, which will be age 65, when I can lock in that fixed loan interest rate of 3% with any Guardian product for that matter. Cash value accrual, but in this example, we're paying the loan interest out of pocket indefinitely. So let's take a look at our comparison sheet. Here, we've got the scenario where we plug money in, let it sit and grow, 100K goes in, 82.5 in cash value. Next year, you pay in 100,000, grows from 82 to 179. So I get my 100K back minus a couple grand there. So I got less back than what I paid in. Next year, paying $100,000, grows from 179 to 280. So I've got the 100K payment back, plus almost another $1,000 in earnings. We always like to isolate the net growth rate. We do not want to account for the payment we made as well. And there's the growth each year, breaking even between years 5 and 6. Over here, annual loan, age 65, $300,000 loan. What is the impact on my policy? Cash value, death benefit. If we look over here, cash value, death benefit. We see just about a $300,000 reduction. Dollar for dollar, well, not quite dollar for dollar on the death benefit. We do have to account for the loan interest. But as we look at this guy, there's my loan balance. Loan interest comes due. I pay the loan interest in the first year. First year that I take the loan, I don't pay anything toward the principal. Beginning the next year, in purple, interest comes due. I pay the interest. I'm also applying $50,000 toward the principal balance. What happens, how this illustration actually computes, is it assumes we make the $50,000 payment up front, chipping the balance down from 300 to 250, and then the interest, the 7282, is generated on the 250. And then that happens each year. So your net out of pocket each year, if this is you, is the loan principal payment plus the loan interest. And that's excluding the first 5 years of funding. So direct recognition contract, when this is paid back, what do you notice there? 832 and 1105 compared to the example where we just let it sit and grow, 871, 1157. So we see a difference there, about 40 grand. The reason why, this guy right here, the outstanding loan balance, still receives a dividend interest rate. But in this example, what's the cost to borrow? without the discount, 3%, which means the dividend applied is 3%, and the non-borrowed money would be 5.65%. That's a spread. Granted, I'm paying much less interest as well. However, many could be uncomfortable with that. That's where we like to look at options with the cash value collateral loans. What I'll add with that low loan interest rate, because the loan interest rate here is fixed technically at 2.91%. If I'm at least paying the interest. If I'm not, it's fixed at 3%. Where that's advantageous is if I'm looking at an income scenario where I'm not planning on paying anything back anyway, and I just want to lock in the lowest interest rate possible, which if I'm not paying any loan interest, that can permit me to take a greater amount of income when I look at disbursements. As we wrap up, looking at the other guys, here's what the policy looks like if I don't pay anything back. 3% cost to borrow. A little too far. There we go. There we go. 3% cost to borrow. There's the clean $9,000. I do not receive the discounted rate. What happens? Age 85, 737 in cash value, 901 in death benefit, compared to the example when I never took the loan, 1.6, almost 1.7 million in cash value. So again, good to look at these scenarios up front. And then we have what it looks like if I elect to pay the loan interest out of pocket each year. So I hope you enjoyed this video and the prior videos. If you have any questions, please feel free to reach out anytime. We always love talking about this stuff. If you enjoyed it, please hit the like button, subscribe for more, and as always, I hope this helps. Thanks so much. Hey guys, Steve Parisi here. If you enjoyed the content you just saw, please subscribe, like, and hit the notification bell for future videos. If you'd like more information or to see some custom policies for yourself, feel free to call or email our offices at the contact information below.